Great to see everyone. I think we need to get Vern and Ann agents. They might have a new job by the time we come back here for Global Alts 2024. But next up is a topic near and dear to my heart, hedge funds, which stood out in a volatile year for public markets. So this morning's third session sets out to explore the value proposition for hedge funds in 2023 and will be moderated by my colleague, Jack Ingalls, CEO of AMA. Please welcome Jack and his esteemed panelists. We have Bruce Amlick, CIO, Head of UBS Hedge Fund Solutions, Diana Amoa, CIO, Long Bias Strategies for Kirkoswald Asset Management, Mark Baumgartner, Chief Investment Officer of the Carnegie Corporation, and Matt Smith, Investment Director, Ruffer. Jack, the stage is yours.
Thank you very much, Michelle. Morning, everybody. Every January, year after year after year, I seem to have read in the press from certain commentators a certain amount of satisfaction as they reported that hedge funds had yet again underperformed the S&P. Ha! But they couldn't do that this year, could they? So that was 2022, and I think we all know what has happened. But of course, hedge funds are not just a large, homogeneous group of people doing exactly the same thing. It's a very dispersed group of managers, of funds, of strategies, etc. And I think we all know that in 2022, some did extremely well, some did not so well. I think on average, certainly the data that we follow, hedge funds did deliver a return on the aggregate assets under management, a modest positive return of about 1%. So therefore, beating a historical 60-40 portfolio by quite some considerable margin, sort of getting on for 20%. But that was last year. So the title of our panel is The Value Proposition for Hedge Funds in 2023. And we've got a pretty good panel here of different perspectives, I think. But I'm hoping I can kind of weave them in so that we leave you under no doubt at all that the value opportunity, the opportunity to create alpha in 2023 is very much alive at a time when the future prospects for traditional long-only investing in bonds and equities has never looked dimmer. Perhaps 60-40 is not completely dead and buried, but it's certainly got a bit of turf on top of it. So I'm going to forego the introductions of our panel because it'll become obvious as we go along. But I'm going to start with Mark Baumgartner from the Carnegie Corporation, runs a large foundation. And in Mark's position as CIO, he kind of looks at the entire portfolio, the whole portfolio construction across asset classes, across strategies. So really want to pick your brains here, Mark, a little bit about where, as you think about the whole portfolio, where do hedge funds fit in? And how kind of optimistic are you for 2023, and what changes are you putting in place at the moment?
Sure. Thanks, Jack. Nice to be here, and just follow up on your comment about 60-40. I think that's right. The whole purpose of 60-40 is to talk about diversification, and what I would posit today is maybe we think about that 40% as not being what it traditionally has been, which is bonds, but being hedge funds in a portfolio. Maybe more specifically, unconstrained strategies. And so, I will I'll give a nod to my colleague who may or may not be in this room. Preet Chawla oversees part of our public portfolio and says, bottom line up front, bluff. And so the bluff here, and I'll start off with it, is the value proposition of hedge funds is the enabler of creativity for the team and for the portfolio, and I'll go into that. But just to step back and say, what is it that we're actually trying to do with the portfolio? What are our objectives? And at Carnegie, where I've been for the last 2 years, is very different than the place I was before, the Institute for Advanced Study, where I was for 7 years. And we had a very different objective there. It was a low-risk portfolio, but a low-risk portfolio with a high return target and a tolerance for hedge funds. And so we ended up with about 75% hedge funds in that portfolio. It's unusual. This portfolio, we have a higher target return, just like many of our peers, inflation +5, and we're faced with this environment, which is very, very difficult, right? It's a low real return environment. It's going to be very tough to get there. We've pushed out as far as we can on the illiquidity front. We've pushed out as far as we can on the equity front, and we still can't get to those numbers that we need. And so we need to add alpha, and that's really what the point of pulling some of our fixed income target out of the portfolio and moving into hedge funds. And then this gets back to creativity. What I think of hedge funds, it's such a broad term, and we need to be creative in the portfolio to hit those return targets. And so people say, well, hedge funds aren't going to get us there, or low return types of things. And I'm saying, well, not the way we do them. So we are actually targeting high-risk types of vehicles, high return potential, the real ability to diversify from an alpha perspective, and we're okay with fees. This is the other thing. If your objective in the portfolio is to have a low-fee portfolio, well, you're not going to invest in hedge funds. If your objective is to meet a return target within a risk budget, then you might want to think about these strategies. So again, back to, if you're unconstrained, it enables creativity for us to address the huge challenge that we're facing in our portfolio.
Right. I'm glad you mentioned fees there. That was going to be one of my follow-up questions, but you already asked it, because the title of our panel is The Value of Hedge Funds. And you've just heard it here, ladies and gentlemen. He's okay paying fees if he gets the performance that you are seeking, and you are a performance seeker. Bruce, turning to you, Bruce Amlick from UBS Global Hedge Fund Solutions. I guess probably describing you the pure hedge fund guy here, because so you've already got a vested interest in hedge funds delivering and providing value. But Mark talked about kind of objectives. It may be that you've got some different objectives that you're trying to meet for your clients. I know when we spoke earlier, that was very much the case. Do you want to sort of talk us through how you think about what it is that your clients are expecting out of their hedge fund allocations, and then how you set about meeting that?
Yeah, sure. No. Look, I think our clients are really just looking to us for diversification in their portfolios, right? So our responsibility is to try and deliver on absolute returns. Typically, a target would be like LIBOR plus 4%, and really trying to deliver consistency in that return. Ideally, we don't want to lose money in any year. So in a year like 2022, when you have equity and bond markets down almost 20%, being able to post a positive number is really a pleasant surprise for a lot of people, and really important as a diversifier. But doing that it's hard, right? Pure alpha is really hard, and hedge funds are made in all different shapes and sizes, and at the end of the day, there's a lot of long bias stuff, but at the end of the day, we're looking for truly hedged solutions, because our mandate is absolute return. So we're investing in every strategy out there, trying to get to that, from equity hedged to relative value and arbitrage, trading, credit. And at the end of the day, we bring it together in a mix of strategies where we have some hedge fund strategies that really prefer a lower volatility environment. So like equity hedged might be one of those, or credit. And then we have strategies that really prefer more volatility, like relative value and trading managers. And what we do is bring those two together, and it creates a really robust alpha machine that can create all-weather returns. And so, that's what we attempt to do. I think along the way, we all have market views, and for us, an important part of our value proposition is translating that market view into additional alpha. Over the past 18 months, we've been worried about inflation, and essentially trying to figure out, okay, what hedge fund strategies are really going to do well in an inflationary regime where where you get a lot of volatility, dislocation in risk assets. And what we decided was we should really pivot more, move our feet, and move towards macro, fixed income relative value, and commodity trading managers. And so, and thankfully that has been a good playbook up until now. And here we are looking forward at 2023. And it's an interesting setup, right? We just had a huge January effect rally, I think, and now we're at a point where you're going to see earnings start to roll over. You still have the Fed with rate hikes left, quantitative tightening, and quite frankly, I'm not even sure if they're really going to be able to pivot this year. What that means is that you're going to see a lot more volatility this year across market asset classes, and we need to be positioned to take advantage of that. What it means is that we're going to keep our beta down this year. At the margin, we're focused on more tactical managers. We think it could be a good stock picking environment, good credit picking environment, but not one where you want to be directional quite yet, and you want to be tactical. But from a strategy perspective, we still feel really compelled by what we see in macro and fixed income relative value, and also commodity trading. So let me just touch on those just a little bit. Macro trading has been around forever, but it's probably one of the best times I've seen for macro trading really since the 90s. We're seeing the two key components and drivers of returns there. One, volatility. Two, central banks in play. Both of those are in gear. And I think if you look at 2022, it was a year where you had a lot of directional trends and directional trades like long dollar, short fixed income, and short equities was really profitable. But this year is going to be a lot more nuanced. Obviously, we're approaching terminal rates, the peak, and so volatility might be a little bit less. And the alpha that's out there for macro managers might be more nuanced, more relative value. A perfect example of what is poster child for this opportunity is looking at the curve inversions in the U.S. yield curves, where 2 cents is inverted, and we think that steepening trades there are a perfect way to take advantage of that asymmetry and make some money this year. Additionally, Japan, you have an emerging inflation problem, 4% inflation, and you have the BOJ trying to cap rates at 50 basis points, which we think is really unsustainable. So you could see higher rates in Japan. So within macro, interesting. For fixed income relative value, does well in volatility, does well when there's uncertainty around inflation. But what excites us about it is that we've moved from a quantitative easing environment to a quantitative tightening environment. So you've moved away from vol dampening to all of a sudden in quantitative tightening, you've got liquidity that's difficult to come by and a lot more volatility. So if our relative value managers are real liquidity providers to the market, and so they should get paid a lot more for what they do this year. So it's a big part of our portfolio right now. And the last thing I'll mention is commodity trading. I think up until the last couple of years, there wasn't much to do there. A lot of managers went away, and that all changed a couple of years ago. And you've seen the banks move away from commodity trading. You've seen spec capital move away, and so markets are super inefficient. It's hard to find good managers, but if you can, massive inefficiencies, and a lot of thematics driving supply and demand that are really interesting. On the supply side, you've got ESG that's driving up the cost of capital for fossil fuels and constrained supply. On the demand side, you've got a China reopening or green energy transition, which is also driving demand for metals. So, but interestingly, it's all about the alpha. It's not a directional trade. You really want to make sure you have a manager that can make money long, short, or in relative value. And for us, the biggest money-making trade in our portfolios for the past 2 years has been short natural gas. So go figure. But that's it for us.
Good. Well done for positioning early. You could presume that was a benefit for you last year. But as you say, it's all about the alpha. And Dan, I want to turn to you because emerging markets is, and particularly in a global macro format, is the origin of Kirkoswald, your firm. You joined to run and set up their long bias strategy. I just wonder how you're thinking about hearing sort of comments about you don't want to be long beta at the moment kind of how how you view emerging markets, which I think have always had a long bias tilt anyway within hedge fund portfolios. But kind of where the opportunity lies within emerging market strategies at the moment is the way that you see it would be good to share with us.
Yeah, so I think one of the things that allocators find frustrating about emerging markets is historically they've allocated to managers who don't actually look for alpha. What they tend to deliver is just the levered beta in the space. And when you think about every time EM goes through this boom and bust cycles, it's always investors getting caught in the likes of Argentina in a default or Turkey. Our ethos when we think about EM as a firm is our investors trust us to make the active decision on when we need to be in a country, when we need to be out of a country, whether we need to be long or short a country. That's the job we do. As a firm with over 50 investment professionals who have really truly focused on emerging market, we actually believe there is a lot of alpha to be gained in the space. And if you trust the people who are looking at it day in, day out, they can actually get that alpha. So to give you context, last year, one of the best performing currencies was the Mexican peso. It was up almost 15% on a total return basis. When everything else was being dominated by the dollar, there were actually opportunities in EM where you could have monetized without necessarily only just being long dollars. Best performing mainstream EM bond was the Chilean peso. Despite the drastic move we had in treasuries, Chilean 10-year bonds managed to rally 150 basis points last year, right? And so that for us is the opportunity set that emerging markets present to allocators where you can actually come into EM and provide uncorrelated alpha. You could have actually made money being long a bond last year rather than just having the unidirectional trade of pay rates everywhere. So that's the first point. Second point is tied to the theme today and to your question on what's the opportunity for this year. The biggest singular change we had last year, end of last year, was the China reopening. I think we can all agree no one thought we'd go from COVID zero to COVID is just another version of the flu in China. Markets weren't braced for quick reopening. The other two big themes were not to do with the US. It was the Bank of Japan starting to indicate they were going to ease up on yield curve control, and the ECB taking the leadership in being the most hawkish developed market central bank. The point in highlighting the three big shocks we had in December last year is just to say the opportunity is starting to move away from the US. Where we expect to see more volatility and more opportunities to garner alpha is actually outside the US for this year and in the rest of the world. And the beauty of looking at things from an emerging market perspective is, as EM investors, it's not a surprise to us that EM central bankers were hiking in 2021 whilst the rest of the world was still stuck on the transitory narrative. Because we've lived with inflation, we know what it looks like. Brazil, think about most emerging markets. Policymakers are used to inflation coming. They know the right response is hike quickly. So as an investor, 2021, everyone had agreed inflation was going up except developed market policymakers. If you'd positioned for that trade in developed markets, it was a terrible year. The Fed only started moving last year. Whereas if you'd actually positioned for that rate hiking for an inflationary shock in EM, fantastic year. All our central bankers were already moving and hiking quite aggressively. Likewise, we're seeing inflation has peaked in most EMs. And so I think this year you'll have great opportunities from a diversification perspective to look at opportunities there.
Great, thank you. We're getting a theme here, right? There's sort of alpha abounds in 2023. So we wanted to save some time for Matt at the end as time absolutely starts running out on us. My fellow Brit at the far end here. Matt, you co-manage two of Ruffer's flagship funds. I think you've got close to 30 billion, we call it pounds in our country, don't we, of assets under management. I think your your sort of mantra is a bit like a doctor's one, do no harm, which is lose no money for your clients. You want to talk a little bit about how you position your portfolio as a portfolio manager and then bring it up to date in 2023. I know you delivered positive returns last year in a very challenging market. Kind of what you're doing now to generate that alpha, repeat that process again in 2023.
Yeah, sure. Thanks. So we're trying to deliver positive absolute returns for our clients. And I think the importance of that has been forgotten. Over the last 30 years, investors have been very spoiled by beta. We get, you hear a lot of comments, maybe even have thought it yourself. I don't need hedge funds. I have a balanced, diversified portfolio. Or, we do our own asset allocation. We don't want you doing that. And I think there are three kind of key reasons why what we offer, what hedge funds offer, are important today. The first is that if beta is going to be a headwind rather than a tailwind, and I think it will, varying strength of headwind, but a headwind nonetheless. You need to unlearn the lessons of the last cycle. So the optimum for the last cycle was a passively implemented 60-40 portfolio, maybe risk parity, something like that. Today, that needs to be an actively managed, unbenchmarked, unconstrained strategy. The optimum for the last cycle was leverage and a beta focus. Today, you need humility and an alpha focus. And finally, the best strategy for the last cycle was to be diversified. And really what that meant was to have a load of different duration plays in different buckets in your portfolios. Today, you need to be genuinely diversified. What do you own in your portfolio that will make money if interest rates rise, if inflation rises? Hedge funds, I think, are a key answer, provide all of those things. So secondly, you need absolute returns, not relative returns. This spoiled by beta focus means that people are very heavy on relative returns. We were set up to provide generational wealth with a way of avoiding that and going for absolute returns. We've delivered 9% average annual returns for over a quarter of a century, and we've done that primarily by avoiding losses in the dot-com bust, credit crisis, March 2020, 2022. Those are all periods in which we made money. And we've done that by not, as Mark says, some hedge funds, they're out there trying to be right, trying to hit the ball really hard a couple of times a year. We take the full suite of hedge fund tools, which you'll need for this cycle, and we try to avoid being wrong to deliver on that positive absolute return objective. And finally, what's the relevance of us, of hedge funds for institutions? Well, what we bring is equity-like returns with fixed income volatility and a low correlation to either of those asset classes. That will be a critical allocation to have in your portfolio for the coming cycle. How are we positioning today? You asked me earlier about cash rate. Cash rate's gone up. How are you going to beat that? I think the key answer is the cash rate has gone up. The risk-free is at 4+, and really, some asset prices have adjusted, particularly in public markets. I won't be rude about the other panels. But flows have not. Positioning has not. If you think about the mid-2000s, the last time risk-free rates were at this level, what did your portfolio look like? It probably did not look like it does today. So it's a long way of saying we think that with rates at this level, there is a lot of money to come out of financial markets. That keeps us pretty bearishly positioned. But at the same time, I I think within the next 12 to 18 months, we are going to see central banks capitulate on their tightening attempt, probably at a level where inflation is too high for them to get away with doing that. And that's why, our primary risk exposure is to long-dated inflation break-evens, which at 2% price perfect central bank credibility, skill, and that seems unlikely to us.
Good. But you've been looking at the clock as well. We've only got 51 seconds. How am I going to fill that? So I think what we've managed in a very short space of time, and by the way, 30 minutes was about a fifth of the time as it took me to get through immigration at Miami Airport the other night. But anyway, we have, I think, got a sense out of this that there is, we knew last year was challenging. Some funds delivered well. The right funds, the right managers, the right strategy, right diversified portfolio in that. There are really some good alpha to be generated here if the ongoing situation that we're facing. So the message is people should have more hedge funds rather than less hedge funds in their portfolio. So I think in terms of the value proposition question, I think that's the answer to it. So with that, we've run completely out of time. I want to thank you, guys, for joining on the panel today. Sorry we couldn't have longer. And thank you all for listening.